Joining us now is Dan Nathan from RiskReversal Advisors. Dan, good to see you.
Mel, great to be with you.
So Staples, the only winning sector on the week, up 1%. We were talking to Brian Kelly yesterday, Beakers. He said that he was buying Philip Morris, which seemed nuts to me. What's your take on the markets here?
Yeah, don't smoke. Stay in school, kids. I'm not with Beaks on that one here. I mean, listen, this was a really interesting week for me because if you look at a lot of those macro assets that you thought might have been moving around because of all the uncertainty with what's going on with Russia and Ukraine, I think it's interesting that we end the week with the dollar basically flat, with rates a little bit lower than where they were just a couple days ago. The 10-year U.S. Treasury yield was well above 2%. Now it closed at 1.92 or so. The VIX was actually down today. So, crude oil was down, Mel. I mean, so it didn't look like we were raging on risk assets, risk off sort of things, other than high valuation tech stocks. They just continue to get bludgeoned here. And I think last week when I was on with you and Sarah, I said it is not over, and it's not going to be over for these names. And listening to Kathy Wood yesterday with Scott Wapner, I thought was really interesting. She made a lot of great points, except one, in my opinion. When you see such a large part of the market where so much positive sentiment was kind of encapsulated in, and they crash, and that's what's happened. They've crashed. A lot of these tech names, they're not coming back anytime soon.
We were talking to Victor Jones earlier also, Dan, and I thought he made an interesting point in terms of his take on Kathy Wood. And, he said you have to acknowledge the role of liquidity and all the excess liquidity and what that has had on some of these areas like ARK Innovation, for instance. You have to also acknowledge on the way out when the liquidity is coming out that this trade may not get back. But for traders, it doesn't need to get back to those levels. If you're in now, you could still see a 50% bounce.
No doubt about it. And there's been plenty of bounces like that of names that have been down 50, 60, even 70%. You can make a lot of money if you can be nimble and you can pick a bottom. I'll just say this, and I think Victor makes a great point. I mean, everything that she had to say is divorced of the reality that with a rising rate environment, investors are going to pay less for that decelerating growth that a lot of these companies are seeing. I'll tell you this, the most important thing that I saw happen in the stock market this week was NVIDIA reported a really good quarter. It gave a great guidance. Investors sold it. It's been 10% in the last 2 trading days because what? They didn't like flat margins on a company that just guided up revenues, basically 10% in the current quarter. $600 billion market cap company that had north of a 20 times sales multiple just a few days ago. So to me, the reaction to that result is really important. Keep tracking that. If we lose some of these sentiment winners that are still relatively holding up, that Apple, Tesla, NVIDIA, obviously a few others here, then we're in for some problems.
So Dan, where are you exposed then? It sounds like you're not touching tech. So where are you?
Listen, I will tell you this, Sarah. I think the QQQ, the NASDAQ 100, we know 6 stocks in that index of 100 stocks make up 45% of the weight. And again, if we have Microsoft, Apple, we've already lost Facebook. If you have Alphabet, Tesla come in, then the QQQ, the NASDAQ 100 is going to be the single best trade. Forget the ARK Innovation ETF. You buy the QQQ because you're going to get these massive companies that have corrected 20, 30%, and they're going to be the leaders on the way out. But then to Mel's point, you're going to get the dozens of stocks that are truly innovative, but their valuations got way out of whack over the last 2 years, and you're going to get the benefit of them rallying 50% over a year or two. Never getting back to those prior highs, but they're going to have really nice rallies. That's how I would be thinking about legging in to tech stocks and innovation over the next 3 to 6 months as the market tries to bottom.
Which innovative stocks are you keeping your eye on? What's on your radar?
Listen, I think Zoom is really interesting to me. It's below 10 times sales now. That was a company that was trading north of $100 billion market cap that was trading over 30 times sales. I don't care what you think the work environment, the hybrid environment is going forward. That is a feature that a lot of people will be using from here on out. A lot of the competition from some of their major competitors, the big platform companies, really haven't made it a dent. It was a valuation issue dealing with decelerating growth. So that one's going to be really interesting interesting to me. I also think that, NVIDIA, again, I'd love to see that stock's down about 33% from its highs in November. You get that thing back down below $200. That's where you want to be in the semiconductor space there. So to me, I just think that the legging into the QQQ makes a lot of sense as we continue to see a downdraft. That thing's down about 15, 16% from its all-time highs made in November. You want to see that, at least 20, 25% from the highs. That's when you really start getting in there.